Hello, and welcome to our next NAP. NAP stands for Nonprofit Auditor Points, and I'm Irina Ryshkova, Nonprofit Auditor. I have a small CPA firm located in downtown Oakland, and we serve nonprofit organizations by providing assurances and tax filing. I designed these NAPs to help nonprofit communities to understand better accounting topics and answer. Hopefully, these NAPs will help answer some of your questions. Full disclosure, these videos are not authoritative and they're just based on my knowledge and experience. If your organization have some questions about the topic, you need to consult your own auditor or financial consultant. Okay, let's start. Today's exciting topic about leases. New lease standard 842. We find that a lot of nonprofit organizations still struggling with implementation 842. So hopefully today I will be able to answer some of your questions. First of all, the standard is implementation date for nonprofit organizations was 2022. And the standard needs to be applied prospectively. What it means that the organization should not take the old leases and start recalculating them back only prospectively from 22 moving forward. Why this standard was implemented? Let's just take a look on the bigger picture so you understand why we have a new standard. What was the purpose? If you think about it, your organization has any liabilities on the books. If you owe for a loan, if you have a debt, if you have accounts payable, if you have accrued expenses, you do have a liability on a balance sheet for that because your organization owes this money for services, for debt, whatever. If the organization signed the lease and it's a long-term lease and the organization owes to landlord for the next X years, maybe 3, 4, 5, 7, 10 years, that liability was never on the balance sheet. It was off the balance sheet. We had just a footnote disclosure where we would say that the organization signed a long-term lease and here's the future minimum lease payments. However, that liability was never present on the face of financial statements, so the readers of financial statement had no idea that the organization is liable for this future liability. For the transparency purposes, this liability should be present. And if you, like me, I never was able to get out of the lease that you sign. Once you sign, the organization is liable for the lease. So this liability is pretty much certain that the organization will be required to pay future payments. Therefore, it absolutely has to be on the balance sheet. But if you think about it, with that liability, organization also has a right to use the asset. It could be office, it could be copier, it could be conference room, whatever asset the organization will be liable paying for, but the organization also have a right to use that asset for X amount of years. Therefore, when organization signs a lease agreement, it's acquiring a right of use the asset and also is obligated to pay for that asset for that amount of years. Therefore, this new lease standard to increase transparency to the readers of financial statements requires nonprofit organization to record right of use asset, which is asset, it's intangible asset on the balance sheet, but also record future payments on this asset as a liability. So if you think about it from the asset standpoint, it's an intangible asset, and from the future lease payments, it's the actual liability that the organization will need to pay. So this is the reason to creating a new lease standard, because this liability and asset before was completely off the book. Now this it's going to be on the face of financial statements, and readers will be able to see what is the right of use and what is the liability, future liability. This way, readers of financial statements can better assess outstanding liability of the organization and overall risk of the entity. Okay, saying overall understanding of the standard, let's see what the standard actually did. Prior 842, all leases we had a capital lease and we had finance lease. Capital lease, it's a lease where it really was not a lease, it was more like organization was purchasing the asset and become like a capital asset, like plant, property, and equipment. And finance lease, capital, it used to be capital lease and operating lease. It used to be capital lease and operating lease. Capital lease, it was like your plant, property, and equipment. And operating lease, it's your regular lease where you were just leasing the right to use the asset for the period of time. Now, under new standards, capital lease is called finance lease and operating lease is still operating lease. So the change in terminology, capital lease now it's finance lease and operating lease is still operating lease. Let's first of all define what is the difference. Actually, under new standard 842, capital lease or finance lease definition did not change much. So pretty much the same type of leases we still capitalize, and the treatment of the leases, capital lease, also did not change. Capital lease under old standard, we would record as a fixed asset and we would depreciate it, and if it's outstanding liability, it will be just liability on the books. Nothing has changed here. The only thing that changed, the standard get rid of the percentages, how you determined whether it's actually capital or finance lease, and they only describe more in terms how you decide whether it's a capital lease or not. Again, capital, old terminology, finance lease, it's a new terminology. So I'm gonna move to the new terminology, finance lease. How you decide that this is finance lease? There is 5 criteria that you have to apply to see if any of those 5 will be satisfied. That's become a finance lease. Number 1, if at the end of the lease title gets transferred. So even if you receive a lease agreement, says lease agreement, but you do see that at the end of the lease organization receives a title to that asset, meaning ownership, 100% ownership, then it's actually finance lease. And the asset needs to be capitalized. Number 2, there is a old terminology, we use bargain purchase option. Now they're saying purchase option that most likely will be exercised. Same type of idea. And typically what we see, it's when lease agreement and there is an option at the end of the lease to purchase the asset for $1 to something like maybe $100. So definitely will be exercised, right? So it's bargain purchase option. So it's the second criteria. If you see that on the lease, then it's a finance lease and the asset needs to be capitalized and depreciated like any fixed asset. So number 3, if during the lease term, the major part of remaining economic life was used. Before, we said during the lease term, the organization should use up 75% of useful life of the asset. For example, if it's a computer, if you're leasing it for 5 years, most likely it's 75% of economic useful life. So, but now there is no percentages. It says lease term is major part of the economic life of the asset was used. Again, if it happens, the asset is capital assets, it needs to be capitalized, becomes part of plant, property, and equipment and depreciated. It's not operating lease. That was the third criteria. Number 4, present value of lease payments is substantial part of total fair market value of the asset. Before, the standard would say that during the lease term, the organization paid 90% of fair market value of the asset. So now, again, percentages are gone, and it just says that during the lease term, the organization paid pretty much substantially all value of the present value of the asset. Again, if your organization is leasing medical equipment and for 5 years, and over a period of 5 years, the organization paid $90,000 of the asset, and if you look at fair market value of that asset, it's $95,000. So it was really not a lease. It's your capital under old terms or finance lease under new terms. And the last criteria, if it's met, it's specialized nature of the asset. For example, if I will order a sign that says Irina Accountancy Corporation to put on a building and I will lease it for 5 years, it's not really a lease, because even after 5 years, nobody will need that sign. It's a very specialized nature asset that specifically was done for my firm, so it's really my asset. Again, if any of those 5 criteria is met, that it's a finance lease, in all terms capital lease, and the organization needs to capitalize it, meaning record as a fixed asset, and depreciate it. And if there's outstanding liability because you're paying for that asset, that's going to be just debt liability. That's it. There is nothing new, same as under old standard. It's a capital under old standard, new terminology, finance lease. Nothing has changed. In the footnote disclosures, it needs to be presented as a finance lease and needs to be described what it is. Therefore, when the organization signs any lease, it's important to understand the structure of the lease and decide whether it's capital under old terms, finance under new terms, or operating lease. Because operating lease now will be treated completely different, and that's what is new standard really for. It's for operating lease treatments and how they should be presented on financial statements. And we will talk about it on my next snap. I will explain in details how operating lease needs to be presented on financial statements. Thank you so much. Please join me for my next snap when we're going to talk about operating leases. Thank you. Appreciate that you've been here with me. Talk to you soon.